This is an urgent warning to every investor watching this video, because what we're seeing right now in 2025 looks alarmingly similar to the biggest financial bubbles in history, and yet most people don't even realize it. Over the last 3 years, the DOW has risen nearly 60%, the S&P 500 has gained around 90%, and the Nasdaq has doubled with over 120% returns, while companies like Nvidia and Palantir have given thousands of percent gains, which many people are calling the revolution. But the question is, are we really in a revolution, or are we living inside another bubble that's about to pop? Historically, since the 1950s, 7 out of 10 bull markets lasted more than 3 years, with an average gain of around 180%, and right now the S&P is only halfway there at about 87%, meaning statistically, we're not yet at the end of a typical bull run. So if history says it's fine, does that mean everything is okay? Not necessarily. Back in 1996, then Fed Chairman Alan Greenspan warned about irrational exuberance 3 years before the market crashed, so being right at the wrong time is as useless as being wrong. If you invested then, you'd still have doubled your money before the fall. So timing the market is impossible, even for experts, and that's exactly why we must understand where we are objectively instead of relying on emotion. The macroeconomics numbers right now look surprisingly stable. GDP growth remains solid, employment is strong, though cooling slightly, inflation is hovering around 3%, the Federal Reserve is signaling upcoming rate cuts, and corporate credit spreads are the tightest since 1998, meaning liquidity is high and companies aren't struggling for funding.
Companies are also genuinely earning revenue, not just hype. All this makes the economy look fine on the surface, but the real story begins when we look at valuations. The S&P 500's forward price-to-earnings ratio has reached 24, while the long-term historical average is around 18 to 20. And if you check past data, every time the market entered above 23 on the forward pay, the next decade's annual returns were close to zero. Statistically, entering above 23 means you were almost guaranteed to earn nothing or even lose money over 10 years. That's worrying. But hold on, this is not the full picture, because never before have 7 companies dominated the S&P 500 like today. Apple, Microsoft, Amazon, Nvidia, Google, Meta, and Tesla now control over a third of the index, so it's more like the S&P 7. If you equalize all companies, the forward pay comes down to 19, which is near historical averages. Add to that the fact that corporate earnings growth and margins are higher than they've ever been, and the price-to-earnings-to-growth ratio peg stands around 1.35, meaning we're not cheap, but also not insanely overvalued. Macros say okay, peg says moderate, valuation says stretched, and experts say, well, nothing useful. Some predict 7,000 on the S&P, others say a massive crash is near. Everyone is contradicting everyone. So, instead of listening to opinions, let's use a data-driven approach to test whether this is indeed a bubble. Historically, every major market crash shared 8 key signs. 1. Extremely high valuations. 2. Very quick price acceleration. 3. Surges in IPOs. 4. Increased credit supply. 5. Euphoric sentiment. 6. Narrow market breadth. 7. Low-quality stocks booming. And 8. A narrative shift claiming old rules no longer apply. If all 8 appear, a crash is almost certain. Let's test 2025 using these 8 factors. First, valuations definitely elevated. The forward pay of 24 is above 2020, above 2008, and roughly similar to 2022, though lower than the 2000 dot-com bubble when it hit 33, so that's one red flag. Second, quick acceleration. S&P up 20% in 6 months when the normal average would be around 5%. Plus, the index has stayed above its 50-day moving average for over 100 days, the longest streak in more than a decade, which clearly shows overheating, so 2 red flags. Third, IPO surges this quarter. We've had 60 for IPOs, the most since 2021, but far below the 400 listings and $140 billion raised that year. Right now, it's only $30 billion, so the IPO market is warm, not boiling, meaning no red flag here. Fourth, credit expansion. Corporate bonds are up 6% year-on-year, loans are up 5%, commercial loans up 8%, and credit spreads are tight but not euphoric. Banks aren't throwing money at everyone yet, so conditions are easier but not crazy, no red flag. Fifth, sentiment. According to the AAII retail survey, 46% of investors are bullish versus a long-term average of 37%, but before past crashes, optimism reached 60% or higher. The fear and greed index is only in the 30s, meaning people aren't euphoric yet. So, still safe, no red flag. Sixth, market breadth. Only 36% of stocks are above their 50-day moving averages, while the top 7 drive most gains. The S&P 500 is up 22%, but the equal weight version only 8%. That's clear concentration and lack of breadth, so we'll mark a red flag here. Seventh, low-quality stocks. Goldman Sachs shows that unprofitable and heavily shorted stocks are up 60% this year. And among the top 15 performers of 2025, only 3 have strong fundamentals, while 6 are financial trash with no profit or positive cash flow. That's pure speculation, another red flag. Finally, the 8th test, narrative change. The media and investors now say valuation models are outdated because AI is the new revolution. We heard the same argument during the dot-com boom when people said the internet changes everything. They were right about the technology but wrong about prices. So, yes, the future bro narrative is back. That's another red flag. Added up, 5 out of 8 warning signals flashing red, giving us roughly a 60% probability that the market is in a bubble. It's not 100% certain, but the risk is high enough that smart investors should prepare. So, what's the plan? Step 1. Keep investing through dollar cost averaging, but increase your pace when your favorite stocks fall 20% below their 52-week high. Step 2. Set strict trimming triggers. If one position grows to large or surges without fundamental improvement, cut back. Step 3. Focus only on high-quality companies, those with positive free cash flow, consistent profits for 4 to 6 quarters, at least 10% revenue growth, strong moats, clean balance sheets, and credible leadership. Step 4. Score every stock using a simple system. More cash than debt gives 10 points, revenue growth gives 10. Operating margin above 25% gives another 10, institutional holding above 60% adds 10 more, and if revenue grows faster than operating expenses, that's another 10. Add these up to find your portfolio's quality score. This system forces discipline and keeps you out of hype traps. And finally, remember, predicting a crash is impossible. Even experts like Greenspan or Buffett can't time markets perfectly. But preparing for one is easy. Diversify, avoid leverage, keep cash for opportunities, and stick with fundamentals. Because whether or not the bubble bursts in 2025, markets always revert to reality eventually. The goal isn't to panic or guess, it's to survive and compound. And that's the biggest lesson every investor needs to hear today. Don't be the person who thought this time is different. It never is.